Learn the art of investing on MoneyWise.
Welcome to the MoneyWise podcast. My name is Sheetal, and today we're going to target our community of women who are on their journey to make sound investment decisions. And one aspect of making these sound decisions is knowing what pitfalls to avoid, what mistakes one is likely to make with the wrong kind of, information at hand. Luckily for us, we have someone who's going to be joining us. She's got a lot of experience in the area. She's the co-founder and principal financial planner at InvestorCart. Her name is Hinal Kuvadia. She's a chartered accountant and also a certified financial planner. She regularly contributes pieces on personal finance for publications like the Hindustan Times, and The Mint has appeared on radio shows as well. So I think this medium is certainly something she's quite comfortable with.
Thank you so much, Sheetal. Thank you for the kind introduction.
It's a very important topic, because very often we begin our journeys with all of the right intentions. We think we've got it all covered, all our bases covered, but there are minefields sometimes that we have to avoid. But I want to start with this aspect of how early one should really begin, because you might have observed in your experience, Hinal, that most teenagers are not really educated about the need for saving or financial planning. And this is usually unraveled or discovered when they are made to grapple with real life responsibilities, such as, financing their medical contingencies, paying home loans, etc. Now, while ignorance of financial matters is undoubtedly a pitfall, how do parents involve children early in financial issues and get them started off with this advantage?
In fact, one can start as early as 3-year-old to explain the concepts of children, like what is money, or what is earning, what is spending, or what is saving, and also charity, that is what is giving. This is not something which should have like a format, that there should be one day for financial literacy. It should be something which parents should do on an ongoing basis. See, in today's times, most of our transactions are happening through digital means, our earning, our spending, everything is happening through digital means. So it's very difficult for younger kids to understand how money works. So parents should involve them in a lot of practical situations so that they get an understanding. For example, taking the kids out, to the bank and explaining the functions of the bank and what a bank does, saving. The bank, how can you withdraw the money from the bank? It's a common myth which kids think that ATM prints money for free. Also, one can play a lot of games, like if there are smaller kids, one can do a lot of pretend play activities, such as having a toy cash register at home. For the elder kids, one can also play board games such as Game of Life and Monopoly. All these things will get them a hang of how money works. One of a very important things is to instill a habit of savings from a very early age.
Right.
Because most of the kids' early interactions with money are usually involving only spending and not earning. See, most of the kids have usually gone to a mall, visited a mall definitely, right? But very few kids would have visited a bank. So having a simple piggy bank or a savings jar is a great way to start explaining the concept of savings.
You have some great ideas over there, because as you rightly point out, you need to walk the talk, and a visit to the bank, never really thought of it, can be very informative and instructional and also fun for a kid.
You're listening to MoneyWise, successful investment ideas that create wealth. Did you know?
Data from AMFI shows that SIP contribution has increased from 43,921 crore rupees in FY 2016-17 to 1,55,972 crore rupees in FY 2022-23, indicating a healthy rise in the interest of Indian investors in mutual funds.
Personal Finance Simplified, only on MoneyWise.
The other pitfall I wanted to highlight is that women, Hinal, I've noticed, save. It's not that this is a concept that's alien. We all know of mothers and grandmothers putting money into jars and, saving for a rainy day, etc. But this money typically remains in the cupboard. And inflation, again, is usually never accounted for with this method of saving. So what would be your direction for women like this on how to take the first step towards investing, which is very different from actually just saving?
Yeah, this is absolutely true, Sheetal. While most of the women are good at saving, they definitely don't end up starting their investment journey. So I would like to tell all the women that it's while you're always good at savings, it's time to start your investment journey. A few things how they can do. First and foremost is goal setting. Goal setting is very important because once you set financial goals, this gives a lot of clarity and purpose on what you want to do with your money.
Right.
And this is the first step to starting.
Mm-hmm.
Also, inflation is something which should be considered at all times. I'll give you an example. For someone who wants to retire, say 15 or 20 years down the line, so they have to take inflation into account and find out the future cost of their corpus based on their current lifestyle. So this is the first step. The next would be budgeting. Jotting down income and expenses helps analyze one's saving and spending patterns. See, it's a myth that following a budget makes one very restrictive in spending. But from my experiences, budgeting gives a lot of control to people because once they know that they are saving enough, and then they can definitely spend on what they want without thinking a lot about it.
Right.
And the next would be having an investment strategy in place. So women can always take in help from either a investment and finance professional, which will help them understand their risk profile, their risk appetite, and chart out an investment strategy for them. So this would be a good way to start the investment journey.
Right, absolutely. Great pointers over there. There's this other area I wanted to highlight while we're on the subject of things to watch out for, right? When a woman gets married, I'm sure you've noticed this as well, Heenal, right? Or is required to shoulder greater responsibilities in life. Sometimes they tend to run the risk of prioritizing themselves a little less. And also add to that, their route to a secured retired life is usually one that they haven't taken at all. Someone else in the family is making those decisions and they are at the mercy then of how good or bad that other person has been. So how can women be a little bit more participative in this whole, their own life, I would imagine, so they don't have to compromise on their own personal aspirations and goals?
Yes, so this is absolutely true, Sheetal. It's a very natural tendency for women to always put others' needs before theirs. So while women are actually givers by nature, they should definitely start putting a goal of financial independence or retirement very early on. Few things how they can start. First, I would always tell everyone, in fact this not only goes for women but for everyone, before investing, always have a emergency or a contingency fund in place. So this usually should be about 6 months of mandatory expenses should be available in a very liquid way, and also having a adequate health insurance. So what happens is if one starts investing without having these measures, like without having an emergency fund or health insurance, then they would have to break their investments in case any unforeseen event happens. So the first thing is always stay protected, have emergency fund in place, and the next step would be to then work out based on your lifestyle and your timeline. One should work out on what is the required corpus, because everyone has a different lifestyle and a different time at when they would like to have their independence. So one should work out at the corpus. Once they arrive at the corpus, the third step would be to start investing. While everyone usually has a different savings ratio, I always recommend my clients to at least invest 30% of their take home for long-term goals like retirement or financial independence. And the next step would be to automate the investments. See, we've always heard this thing that it's not income minus expenses saving, but it should be income minus saving should be expense.
Right.
So, you have the advantage. You can use mutual funds, which are a great investment vehicle. So definitely one should use them optimally and to reach their goals of retirement and financial independence. Right. Obviously, one important thing to keep in mind is one should keep monitoring their investments also over a period of time.
Now, Hinal, that was awesome advice for women to ensure that the later stage of their lives is also secured, right? But as a financial expert yourself with several years of experience in understanding the psychological traits of investors and helping them along, keeping that in mind on their financial journey, what are some of the most common pitfalls, investment pitfalls that you have observed people make, especially women?
What I will do is I will cover the top 3 investing biases which mostly affect investors, whether it's males or females. It affects both of them, and they are the main cause of a gap of the investor returns, like why investors don't make great returns because of these biases.
Right.
So the topmost is recency bias. Now, what is recency bias? This is when investors put too much of emphasis on recent events. If you see in any asset class, most of the investors generally enter the asset class at its peak or close to its peak. This is because they have seen the past performance. So this is, and when they enter and they don't get a good experience. So this is because of the recency bias. The next most important bias is confirmation bias. Confirmation bias is the tendency to search for information that confirms or supports our belief. I'll give you an example. If any investor has a particular liking or is bullish for any sector, then he or she generally tries to absorb good information regarding that sector. And any bad news he or she may encounter will generally be ignored or discounted. We generally try to keep it away from us. Like, okay, no, I like this sector, this is going to do good. So any negative information coming, person tends to ignore. So that is because of confirmation bias. And the third one, which is very prominent, is herd mentality. So this refers to an investor's tendency to follow what other investors are doing. People usually tend to invest in what their friend, colleague, or neighbor has invested. And this is why also we see a lot of investing trends happening. And, the investment might not be the best thing for themselves, but it is something what they have heard from their closed ones. So I would like to sum it up by saying that to avoid falling for these investment pitfalls, one should try to take rational decision and be more and more aware that these biases exist. And how can one be more, read more about them, learn more about them, and try to make rational decisions.
Wonderful. Recency bias, confirmation bias, and herd mentality. Those are the most common pitfalls in everybody, irrespective of gender or identity. Thank you so much, Hinal, for joining us on the MoneyWise podcast today.
Thank you so much, Sheetal. It was a pleasure being here.
You're listening to MoneyWise, brought to you by Bandhan Mutual Fund. Check out the rest of our series for more investment advice. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.